Michigan property taxes in 2025 just delivered a $1,200 hit to homeowners across the state, and most of them never saw it coming. If you own property in Michigan, what I'm about to break down could directly affect your next tax bill. Homeowners opened their property tax bills in early 2025, and a lot of them did a double take. In counties across Michigan, annual property tax increases are hitting $900, $1,100, even $1,200 or more. And the people receiving these bills are not owners of luxury estates. They are retirees in Macomb County, working families in Kent County, longtime residents in Oakland County, who bought modest homes decades ago and have been watching their assessed values climb faster than their incomes ever could. The mechanism driving this is Michigan's Proposal A cap system, and a specific quirk in how that cap interacts with rapidly rising home values means that 2025 property tax assessments are delivering sticker shock at a scale the state has not seen since before the 2008 housing crash. The Consumer Price Index inflation cap for 2025 is set at 5%, the highest it has been in over 2 decades. For a home assessed at $240,000, that translates to a $1,200 increase in taxable value in a single year. This is not a rumor. The bills are already in the mail. Number 1. How Michigan's Proposal A created today's tax shock. To understand why Michigan homeowners are feeling a sharp impact in 2025, it helps to revisit Proposal A, a major property tax reform approved by voters in 1994. At the time, it was widely praised, and for good reason. It stabilized a system that had previously been highly volatile. Before Proposal A, property taxes were based on a home's state equalized value, SEV, roughly half its market value. If a home's market value rose 15% in a year, its taxable value and tax bill rose just as much. This created unpredictable spikes and often pushed longtime homeowners out of their neighborhoods. Proposal A introduced a new concept, taxable value, separate from SEV. Under this system, annual increases in taxable value are capped at the lower of 5% or the rate of inflation, measured by the Consumer Price Index. This limit was designed to protect homeowners from rapid tax increases tied to rising property values, and for decades it largely succeeded. The issue now lies in recent inflation. Because inflation reached 5% or more during 2022 and 2023, the years used to calculate 2025 assessments, the cap has been set at the maximum 5%. In effect, the cap offers no relief this year. As a result, many Michigan homeowners will see their taxable value, and likely their tax bills, increase by the full 5% in 2025. Number 2. The uncapping mechanism. What happens when a home sells? A key feature of Proposal A is the uncapping rule, which plays a major role in today's tax disparities. When a property is sold or transferred, its taxable value resets, typically to the state equalized value, about 50% of the home's current market value in the following year. This rule was meant to prevent long-term distortions. Without it, homes held for decades would be taxed on values far below their true market worth, shrinking the tax base. Uncapping ensures that, at sale, a property's taxable value catches up to reality. In practice, however, it has created significant inequities. 2 identical homes on the same street can have very different tax bills. For example, a homeowner who bought in 2003 may have a taxable value around $140,000 after years of capped increases, even if the home is now worth $340,000. Meanwhile, a neighbor who bought a similar home in 2022 for $330,000 would have a reset taxable value near $165,000 and pay much higher taxes. This gap has widened in recent years. Michigan home prices surged roughly 38% between 2020 and 2024. As a result, recent buyers are taxed on much higher starting values than long-term owners. And now those values are increasing by up to 5% annually. Number 3. Where the impact is hitting hardest: Oakland, Macomb, and Kent counties. The effects of 2025 property tax increases are not evenly spread across Michigan. They are most severe in counties where home prices, tax rates, and recent market growth are highest, particularly in Oakland County, Macomb County, and Kent County. In Oakland County, one of the state's wealthiest areas, communities like Troy, Birmingham, and Bloomfield Hills have seen sharp home value increases alongside high millage rates, often between 48 and 62 mills. A homeowner in Troy with a taxable value of $280,000 could see a 5% increase add $14,000 in taxable value, about $700 more per year at 50 mills. For recent buyers, repeated annual increases are pushing total added costs toward $1,200 or more. Macomb County, including Sterling Heights and Warren, has a more middle-income population but faces similar pressures. With millage rates between 40 and 55 mills, a homeowner in Sterling Heights with a $220,000 taxable value may see about a $550 annual increase. For households earning $65,000 to $75,000, this is a meaningful financial strain. Kent County, anchored by Grand Rapids, has experienced some of the fastest price growth in the state, around 52% since 2019. This surge has widened the gap between taxable and market values, meaning new buyers face significantly higher tax bases after uncapping. In all three counties, rising values combined with a 5% cap are amplifying the tax burden, especially for recent homeowners. Number 4. Homestead exemption and credits that aren't keeping pace. Michigan offers programs intended to ease property taxes for lower and fixed-income residents, but these protections have limitations that make 2025 especially challenging. The Michigan Homestead Property Tax Credit, claimed via the state income tax return, provides a credit to residents with household income below $63,000. It covers 60% of property taxes above 3.5% of income, up to a $1,600 maximum. For example, a homeowner earning $45,000 has a threshold of $1,575. Taxes above that can generate a credit. The problem is threefold. The $63,000 income ceiling hasn't been adjusted for inflation, meaning fewer homeowners qualify today. Claiming the credit requires filing a tax return and actively applying. Many eligible residents, especially elderly homeowners, do not. The credit does not help with timing. Property taxes are due mid-year, but the credit is received months later, leaving homeowners with a cash flow gap they cannot easily bridge. Additionally, the poverty exemption under MCL 211.7U allows qualifying homeowners to apply for partial or full property tax relief. But it must be applied for annually at the local Board of Review, usually in March, and approval is discretionary. Awareness is limited, and many eligible residents do not take advantage of it. Together, these programs provide some relief, but they are not keeping pace with rising home values, high millage rates, and cumulative 5% cap increases, leaving many households struggling despite existing protections. Number 5. Why the legislature is hearing from homeowners and what's being proposed. The 2025 assessment cycle has sparked an unprecedented wave of constituent contact in Lansing. Homeowners across both Republican and Democratic districts are calling, emailing, and attending town halls with their assessment notices in hand, demanding action. Michigan's legislature is closely divided. Democrats hold the Senate 19-18 and narrowly control the House, while Governor Gretchen Whitmer, term limited in 2026, has been cautious about proposals that reduce local or school district revenues. This makes passing tax relief politically challenging. Several proposals have emerged in 2025. The most discussed would lower the proposal A cap from the lesser of 5% or CPY to the lesser of 3% or CPI. For a home with a $240,000 taxable value, this would reduce the 2025 increase from $12,000 to $7,200, saving roughly $192 annually at 40 mills or $288 at 60 mills. Another proposal would expand the homestead property tax credit, raising the income threshold from $63,000 to $85,000 and the maximum credit from $1,600 to $2,200. This change would bring more middle-income homeowners into the program and increase relief for those already eligible. The Senate Fiscal Agency estimates the expanded credit would reduce state income tax revenue by about $340 million annually. Both proposals aim to ease the immediate burden, but navigating political realities, divided chambers, local funding concerns, and a cautious governor makes swift action uncertain. Number 6. What school districts say and why cuts aren't simple. Any discussion of lowering Michigan property taxes runs into the state's school funding system, also created by Proposal A in 1994. Before the reform, local property taxes funded most school operations, creating massive disparities. Wealthy districts could raise $6,000 to $7,000 per pupil, while low-income districts raised as little as $1,500. Proposal A reduced reliance on local taxes and shifted school funding to the state through higher sales and cigarette taxes, plus a statewide 6 mil education property tax. This equalized per-pupil funding and decoupled school quality from local property wealth. Today, most operating budgets are set by the state foundation allowance, determined annually by the legislature rather than local tax rates. However, districts still levy local mills for bond debt, sinking funds, and approved operating levies, part of the combined millage homeowners pay now. Any legislative change that lowers taxable value growth or adds exemptions reduces this local tax base, affecting not only municipalities and counties but also the local school funding tied to these mills. For example, reducing the annual cap from 5% to 3% is estimated to shrink the statewide local tax base by roughly $1.8 billion in 2025. That loss would be felt across school districts, county governments, and municipal services, illustrating why property tax relief is far more complex than simply lowering bills. Number 7. The fixed income retiree problem. Michigan's most vulnerable homeowners. Among those affected by 2025's 5% cap increase, retirees on fixed incomes are the most financially vulnerable. Many own homes outright but face rising property taxes that outpace any income growth. Michigan exempts Social Security from state income tax and provides pension deductions, yet these do nothing to reduce property taxes. For example, a retired household in Macomb County earning $42,000 annually, Social Security plus a pension, with a $180,000 taxable value home pays $9,000 at a 50 mil rate. After a 5% increase in 2025, their taxable value rises to $189,000, and their tax bill rises to $9,450, a $450 jump, more than 1% of their annual income. For a fixed-income household, every dollar increase reduces spending on essentials like groceries, medications, or utilities. They do qualify for the homestead property tax credit. With a $42,000 income, the threshold is $1,470, and taxes above that are 60% creditable, up to $1,600. While the maximum credit meaningfully lowers the effective tax burden, it is delivered months later as a refund. The immediate cash flow challenge remains, making the 2025 increase particularly burdensome for retirees. Number 8. The Board of Review, the escape valve. Most homeowners don't know about. Michigan homeowners who believe their property has been incorrectly assessed can challenge it through the Board of Review. Under the Michigan General Property Tax Act, MCL 211.30, each township or city convenes a board annually in March. Homeowners may appear in person or submit written disputes over state equalized value, taxable value, or assessment calculations. Deadlines vary by jurisdiction but usually fall in the second or third week of March. The board can correct errors, for example, misstated square footage, double-counted renovations, or misapplied comparable sales data. However, it cannot reduce taxable value simply because the increase feels too high. The 5% cap is a legal maximum, not a target. If a homeowner disagrees with the board's decision, the next step is the Michigan Tax Tribunal, an independent administrative court handling property tax disputes, MCL 205.721 to 205.777. Residential petitions must be filed by July 31st of the tax year. The tribunal process is more formal and typically requires evidence such as comparable sales, appraisals, and property condition documentation. Unlike the Board of Review, the tribunal can issue binding reductions in assessed value. For homeowners shocked by 2025's increases, understanding these avenues is crucial. The Board of Review offers a first line of defense against errors, while the tax tribunal provides a more powerful but formal mechanism to contest assessments. Number 9. Comparing Michigan to other states. Why this problem is coming everywhere. Michigan is not alone in facing property tax pressure from rapidly rising home values and assessment systems designed for slower growth. Across the U.S., similar cap structures are being tested by inflation and housing surges. California's Proposition 13, 1978, caps annual assessed value increases at 2%, creating entrenched disparities between longtime owners and recent buyers. Similar to Michigan, but more extreme over decades. Florida's Save Our Homes Amendment caps homestead property increases at 3% or CPI, whichever is lower. Texas, with no income tax, relies on high property taxes and has struggled legislatively to provide relief, passing a $12.7 billion package in 2023 that included raising the homestead exemption from $40,000 to $100,000. These systems were built during periods of moderate inflation and home price growth. Now, with inflation hitting 7 to 8% in 2022 and home prices rising 15 to 20% in a year, the caps that were meant to stabilize taxes instead accelerate increases for recent buyers. Nationally, the median home price rose from $329,000 in January 2021 to $417,000 in January 2024, a 26.7% jump in just 3 years. Michigan in 2025 serves as an early and visible example of stress on CAPI-based property tax systems. Other states with similar structures will likely face comparable pressures as their assessment cycles catch up to soaring market values. Number 10. What relief could look like, and the timeline. For the 2025 tax year, meaningful property tax relief in Michigan is largely out of reach. Assessment notices have been sent, March Board of Review sessions are mostly complete, and bills will be issued in July. Any new legislation would need retroactive provisions, administratively complex and politically tricky, to adjust 2025 bills. The realistic target for action is the 2026 tax year. A proposal to lower the annual proposal A cap from 5% to 3% could take effect for the January 2026 assessment cycle, but only if the legislature passes it and the governor signs it before year-end. Doing so requires agreement on the cap, offsets for the $1.8 billion local tax base reduction, and complementary measures like expanded homestead credits and senior circuit breaker protections. Governor Gretchen Whitmer has expressed support for relief, but has not committed to a specific cap reduction or timeline, balancing homeowner needs against impacts on schools and local governments. Expanding the homestead property tax credit alone carries an estimated $340 million annual cost, a significant budget consideration alongside Medicaid, roads, and pensions. For 2025, homeowners in Oakland, Macomb, Kent, and other counties face increases of $900 to $1,200 or more, driven by the 5% proposal A cap, the highest in 2 decades. The system meant to protect homeowners now functions as a steep automatic escalator in a high-inflation year. Near-term relief is likely to focus on lower and fixed-income households through credit expansions and senior protections. Structural solutions for the cap, impacting working families and recent buyers, will likely be debated in 2026. The core question remains: if the cap is lowered and $1.8 billion in local revenue is lost, where should the money come from and which services should be reduced to fund it?